Obviously, good morning, everyone. Today I'll be presenting on my thesis titled Impermanent Loss and Price Discovery, Automated Market Makers, a Sustainable Exchange Model. Similar to my peers, I'll be kind of focusing on the results and the main significance with an outline, obviously, at the bottom of the slide. So for a bit of background for people that are just joining us or just seeing my presentation, automated market makers are a new type of decentralized exchange where people can trade crypto assets without the need for a counterparty. So unlike centralized exchanges, which use bids and ask orders to value an asset, this automated market maker, or AMM, instead price the asset based on a supply-based algorithm. And this algorithm obviously determines the price by comparing the relative quantities of these two assets, which are held in proportion. And these are held in proportion in a place or reserve called a liquidity pool. So as traders buy and sell one of these assets for the other, the quantity within this liquidity pool changes, and this adjusts the price, or the algorithm adjusts the price accordingly. And to simply put, this price algorithm is more or less based on scarcity. So obviously if the supply decreases of one of these assets, the relative price of it increases. However, since both of these assets are supplied in proportion, obviously the increase in one leads to the decrease in the other. And obviously this is characterized through what's called the impermanent loss, which describes the risk for liquidity providers, those that supply these assets, of seeing the value of their reserved assets decrease in comparison to simply just holding the assets off the exchange. So AMM's simple pricing function and democratized way of generating liquidity has seen these types of exchanges explode in volume and value, reaching a market size of around 120 billion USD dollars in just over 2 years. However, no academic study focuses on whether this market type is actually sustainable or not. Will automated market makers become the dominant market in the future, or is it just another haphazardly designed system within crypto? This is the overarching question my study helps answer, or looks to answer. Are automated market makers a sustainable exchange model? So this overarching concept is split into three topics, which help look to explain the different roles that a market must perform and whether AMMs kind of fit the bill, essentially. So the first one looks at the price discovery kind of aspect. And price discovery is essentially just looking at which market is the first to reflect new information. So in this part of the study, I want to determine whether automated market makers either lead or lag behind their limit order book exchange counterparts, for example, Binance or any kind of traditional exchange. Also, I want to see which AMMs are considered the informational leaders, as well as does this leader change between asset pairs. Next, in the second part of my study, I look at the liquidity provision side. So through the perspective of liquidity providers, I want to see if this impermanent loss, which I described earlier, is able to be offset by the amount of fees that they accrue. And I want to see specifically if impermanent loss is a function of the exchange itself or the actual assets dynamics, for example, volatility. Looking onto the third part of my study, I combine kind of the understanding of these two previous topics, looking at the overall efficiency of automated market makers. Here, I basically use impermanent loss as a proxy for the level of informed trades and these fees that liquidity providers receive as a proxy for uninformed trades, because they represent kind of the round trip trades that noise traders make. So then I basically regress these two kind of variables on the price discovery metrics that I calculated in the first section to explain basically the relative informativeness of automated market makers. So onto the three main kind of hypotheses that I have in my study. I believe that, or I hypothesize that AMMs with the highest trading activity will tend to be the price leader. And I believe that this will be consistent across asset pairs. Next, I think that impermanent loss is a function of the asset price dynamics, again, mainly being volatility, with the individual exchange being less of a factor. Lastly, I hypothesize that impermanent loss improves automated market maker price discovery, and the fees actually inhibit automated market maker price discovery. And this is up to a point. And this kind of fine line, or this optimal balance between fees and impermanent loss, automated market makers that kind of handle this well will likely be sustainable in the long term. So just a quick overview of the data and method. I examined 8 different crypto asset pairs within over 11 different automated market makers between the 1st of November 2020 to the 1st of October 2021. I also include a smaller subsample between June and November of this year to kind of capture the newer exchanges that have been released within this year. I use secondly and daily price data to perform the various calculations in my study. And the first one being these 3 price discovery measures, that being the Gonzalo and Granger component share, the Hasbrook information share, and the Putnam's information leadership share. In the second part of the study, I then calculate this impermanent loss and fee compensation, relating it to the overall returns that the liquidity providers receive. And then lastly, I perform a series of fixed effect regressions of this impermanent loss and fees on the ILS to kind of tie the 2 concepts together. So onto the first part of my study of the main results. So here I'm comparing which exchange type is considered the overall price leader, that being automated market makers or centralized exchanges, which I use Binance, which is one of the largest centralized crypto exchanges globally. If I can draw your attention to the right side, where we look at the 2 price discovery metrics, that being the information share, the IS, and the component share, the CS. We see here at the bottom that on average, they display a value of 94%. And what this means is that 94% of the time, Binance is the first to reflect new information. And as you can see, this is quite consistent across the IS and the CS. However, if you look to the left side of the slide, we see in the ILS, this story changes. We see, well, the reason I include this ILS is because it in fact strips out the differing levels of market microstructure noise between the exchanges. So obviously when stripping out this noise, we see that in fact, AMMs are considered the price leader. They are the first to reflect new information 62% of the time across these 8 asset pairs. So determining AMMs as the overall price leader, I then kind of dig further down and looking at the 2 broad types of automated market makers, that being constant function market makers, CFMMs, versus the non-constant function market makers. Here we see that all 3 measures, the ILS, the IS, and the CS, are consistent with each other. So they attribute the CFMMs as the price leader 70% of the time and 62% of the time. I'll also just draw your attention quickly to the top row in the USDC and the USDT pair. We see that non-CFMMs appear to actually lead when not accounting for noise. And then lastly, I perform a number of these kind of comparisons between exchanges, and this is kind of the grand finals, if you would, of Uniswap version 2 versus QuickSwap. So these kind of the 2 price leaders that I found kind of in like a competition style, going one after the other and eliminating the losers. So here we see the differences between these price discovery estimates are actually much closer. If I can draw your attention to the middle of the slide with the information share, we see the average is 51%. So on average, they lead 51% of the time, but that's obviously quite close. Again, however, when you strip out this microstructure noise between the 2 exchanges, the ILS finds that QuickSwap is in fact the price leader 72% of the time. So just a summary of those main results, I find that AMMs lead price discovery over the centralized exchanges, such as Binance. Then I find that CFMMs, constant function market makers, more or less lead price discovery. Then lastly, I determine that QuickSwap is the definitive price leader over the sample. I also show that the information share and component share metrics often contradict with the information leadership share. The implications of this is quite profound. So despite obviously automated market makers' novelty, they appear to efficiently perform price discovery. And on top of that, they seem to perform price discovery more efficiently than centralized exchanges, which have been well established for decades. Next, I find that the larger, more liquid exchanges that being the constant function market makers, tend to lead price discovery. And therefore, that being market liquidity is more or less a good indicator of determining which market is the first to reflect new information, which is consistent with traditional literature. So onto the second part of my study. This here looks at the returns that liquidity providers receive in sample period 1. And this is looking purely at the impermanent loss and the fee compensation. So again, I reiterate that I kind of use impermanent loss as a proxy for the level of informed trades, and I use fee yields as a proxy for the level of uninformed trades. So then this slide is kind of a handy demonstration of looking at the level of informativeness within each AMM. So here we can see again the 8 asset pairs, with obviously each different colored line being a different exchange. We see that the results are quite mixed, with some exchanges such as Uniswap, which we can see in the blue line is quite positive, will achieve positive returns over most asset pairs, whereas Bancor, which we can see is the red line, largely achieves negative returns. So this kind of suggests that Bancor has either more impermanent loss or less fees, and in contrast, Uniswap has either less impermanent loss or more fees on top of that. So in a broad sense, we can see that the top row, specifically, these are the asset pairs with a stable coin. And stable coins are, in this case, are pegged to the US dollar, so their value is tied to 1. So they have very low volatility. We can see that most exchanges are able to achieve either flat or positive returns, whereas in the bottom row, we see that obviously more exchanges achieve a negative return. So this kind of implies, which I will show in the implications in the next slide, the implications of that, sorry. This is just a quick one on sample period 2, where again, we see Uniswap version 2 being largely positive. And interestingly, in this smaller sample period, it appears that most exchanges are able to kind of offset this impermanent loss through the fees. And this is more likely to be the increase in trade activity and volume and interest within these automated market makers, as this is a more recent kind of samples period. So the main results here that I find is that Uniswap is the only automated market maker to consistently offset this impermanent loss in both sample periods. Next, I find that whether impermanent loss is offset or not is more dependent on the exchange rather than the asset. And this is, we can see if I go back, most exchanges are able to, they seem to be ranked accordingly. So Uniswap appears to be on top, then maybe QuickSwap, which is the green line, is either second or third, and then the other exchanges kind of follow. So I also show that kind of where asset pairs differentiate between each other is through the magnitude of returns. So obviously some such as that top row experience much less negative returns compared to that bottom row, which if you saw had a lot higher loss essentially. The implications of this is that I find that impermanent loss is largely a function of asset price dynamics, mainly volatility, although the type of exchange does play a part. I also find that AMMs with obviously large trading volume or small liquidity pools can sustainably offset this impermanent loss. And lastly, which is probably kind of the most important, is that there appears to be an optimal level of impermanent loss and fees in terms of a price discovery perspective. Because as you can see here, QuickSwap is the green line. It doesn't have the highest fees. Uniswap does. So it suggests that obviously there's a optimal level of fee collection and impermanent loss happening here. So remember those previous two graphs don't actually account the actual return that assets receive over the sample period. And this is exactly what I do in this slide, where on top of that impermanent loss and fees, I add the actual return of the asset. So we can see here that I've actually made it consistent on the y-axis with the returns, so we can clearly see which asset pairs are profitable or not. And again, we see that most AMMs follow kind of a similar trend. So they're quite close to each other, yet the differences in returns between asset pairs are actually quite different. And again, we see the top row being largely positive, that being those stable coin pairs, compared to the riskier pairs in the bottom row, where we see most exchanges largely achieve negative returns. So the main results here is that pairs with a stable coin more or less generate positive returns across most exchanges, or if not all, and that risky asset pairs overall generate negative returns for most exchanges. The implications of this is more for liquidity providers. It shows that investing in a stablecoin liquidity pair is a rather lucrative investment opportunity. As well, and in contrast, investing in risky asset pairs does not appear to be financially attractive at the time. And overall, the profitability seems to be largely dependent on asset price movements rather than the exchange, which again makes sense because obviously the asset is the main driver of returns. So onto the last part of my study, I perform a fixed effects panel regression to see the effect of impermanent loss and fees on price discovery. So again, I kind of treat the IL and the fees as these proxies for informativeness. We see the dependent variable being the information leadership share in that first section. And then I take the log of the impermanent loss and the log of the fee return because the data is quite skewed and there's kind of little variation between them. And then I include a number of control variables, that being the daily number of trades, the gas value, which I use as a proxy for kind of the efficiency of the actual exchange itself. And then I include dummy variables, that being representing the Uniswap version 2, version 3, and SushiSwap. And this is to basically help support my results in the price discovery section by comparing the ILS between the exchanges. So this is the regression output. Apologies, but it's a large table, but I'll try and break it down. So I perform the same regression across these 8 different asset pairs, as you can see at the top, which are labeled. Looking at the first row, we see that impermanent loss largely has a positive coefficient with 4 significant pairs being, 4 pairs being significant. Then we look at the fee yield, which suggests that there's a negative coefficient, suggesting that fee yields actually decrease the level of ILS. Next, we look at on the third row, the number of trades, and we can see there's a large positive coefficients, which are highly significant. So obviously that means that it's improving the ILS. Gas value, kind of mixed results, not really too much to look into there. But then looking at these dummies, we see that they are negative. Most of them are quite negative and significant, suggesting that for most asset pairs, it appears ILS is lower compared to the QuickSwap exchange, which I use as the reference category. And lastly, I'll draw your attention to the R-squareds at the bottom, which are actually quite high. Obviously, this is a good sign, showing that the variables that I'm using have kind of high explanatory power.
Jonathan, you have about 3 minutes left.
Yeah, no worries. So the main results here, I find that impermanent loss and trade activity has a positive impact on the ILS and therefore price discovery. Fee yield has a negative impact on the ILS, for example, price discovery, and that the dummy variables have the other exchanges have lower ILS on average compared to QuickSwap. And again, variables chosen have a high explanatory power. The implications of this is quite significant, showing that impermanent loss is a reasonable proxy for the level of informed trades, fees being a reasonable proxy for uninformed trades. It supports QuickSwap as the overall price leader, and kind of further supports that there's an optimal level of impermanent loss and fees within an AMM. So lastly, to tie off the presentation, the number of contributions that my study provides. So again, I provide evidence that automated market makers are a sustainable exchange model. I lay the foundations into further study into the understanding of why automated market makers perform price discovery better than centralized exchanges. I explore and identify factors that impact the price discovery, that being impermanent loss and fees. And then I explore an alternative avenue of investment within crypto markets. And the beneficiaries here we see are, the main ones would probably be software engineers and designers of AMM protocols, obviously because they can see which exchange is able to optimally handle these kind of complex mechanics, liquidity providers in terms of their returns, as well as regulators, because I believe that this market structure is kind of going to stay around. So it's important that they help improve kind of the overall safety of the space. And with that, I finish my presentation. Thank you for listening, and I look forward to hearing your questions.